Welcome everybody to our TCLE, Life Insurance to Fund Buyouts or Loss of a Key Person, Practical Ways to Avoid Tax Traps and Other Pitfalls. I'm Steve Gorin, and with me is Georgia Loukas Demeros. And
hello, everyone.
So, hello, Georgia. Before I get into the substance, I have a little story to tell you. There was this skydiver, and he was parachuting for the very first time, and he was pulling and pulling and pulling on his parachute, and it wouldn't open. And as he's plummeting to the earth, he sees shooting up from the ground somebody, and he asked the person shooting up for the ground, "Do you know anything about parachutes?" And the person shooting up for the ground says, "No. Do you know anything about gas stoves?" So today we're hoping to help you avoid any traps, anything that might blow up in your face, especially any tax issues. We're talking about, we're going to be talking today about ways for owners to be bought out, tax traps, buy-sell drafting issues, and opportunities. And then Georgia is going to introduce for us on the next slide what we're going to be talking about.
Thank you, Steve, for that introduction. So the first part of the presentation, I'm going to start with the different ways for owners to be bought out. And here in our first slide, we have an example of a company, Widget Manufacturing Corporation, has been in business for a number of years, and it's owned equally between George, Steve, and Irene, meaning they each own a third interest in the company. And their basis, which I'm going to tell you now, so just remember that because it'll come into play when we talk about another section, is $100, meaning that they've put in about $100 each to start this company. So when we talk about the different types of ways to be bought out in a company, there's really two ways, and they are redemption versus cross-purchase. So in the redemption situation, using our example with Widget Manufacturing Company, what would happen here is in the buy-sell agreement, if they decided to fund with life insurance, which is one of the very simple ways many owners decide to fund buyouts at death, is that Widget Manufacturing Company would own the life insurance policy. And so that if any one of the shareholders passed away, and I'm sorry, Steve, but you're going to be the first one to go. If Steve were to pass away, then Widget Manufacturing Company would receive the life insurance proceeds and then turn around and use those life insurance proceeds to pay Steve's personal representative and purchase the shares.
Georgia, I knew that working with you would be the death of me.
I know, I told you. In a cross-purchase type of situation, the life insurance here is not owned by the company. Rather, it's owned by the shareholders. So Georgia would own life insurance on Steve and Irene. Steve would own life insurance policies on the lives of Georgia and Irene would own on Steve and Georgia. So if Steve passed away, Georgia and Irene would receive life insurance proceeds because they're holding policies insuring his life, and then they, in their individual capacity, would use those proceeds to purchase shares from Steve's personal representative. One common theme here you could see is that really with life insurance, you follow the money. So you follow the money where it's being paid as that being the purchaser, and that can kind of help you keep straight the difference between a redemption versus a cross-purchase. And then the third option is this life insurance LLC, which really is a subset of a cross-purchase, and that it combines the cross-purchase option but uses a different type of vehicle to do it, which we'll get into more of those details later on. So let's talk about our first option, redemption. So Steve's passed away and the company has received life insurance proceeds on Steve's life. Well, there's some issues with the redemption. The first one is that there's this potential for tax exposure. So the general rule usually is when life insurance is received, it's received income tax-free. However, if you have a C corporation, so if Widget Corporation was taxed as a C corporation, we could have exposure to what's called the alternative minimum tax, which would result in the company now possibly having to pay some income tax on life insurance proceeds that were otherwise supposed to be received tax-free. So that's one of the significant issues with a redemption. You have to be very careful depending on the type of entity you're using. The other issue is that assuming that the life insurance proceeds that Widget Co. received on Steve's life were more than enough to purchase his shares. So they have some excess proceeds. And they want to get those insurance proceeds out to the surviving shareholders, to Georgia and Irene. Well, the company could have some tax issues in trying to get those proceeds out. They could be deemed as taxable distributions.
Depending on the type of entity.
Depending on the type of entity. Again, you have to be very careful in a redemption what type of entity, and especially if you're using a C corporation. The next potential issue is with lenders and creditors. Many companies, including Widget Manufacturing Corp., may have loan agreements, and those loan agreements may have covenants in there that limit the use of corporate funds to buy out. And so that could significantly be a problem for Steve's personal representative if the life insurance is stuck in the company and can't come out to buy his shares. The next one is the loss of step-up. And so in this situation, remember in the beginning I told you how Georgia, Steve, and Irene each had paid $100 to form Widget Manufacturing Corporation. We'll assume that's their basis. So in the redemption situation, if Steve passes away and his shares are now worth $200 and the company purchases the shares, the $200 that the company paid for those shares do not have any effect on Georgia and Irene's basis. Their basis continues to be $100 in Widget Manufacturing Corp., even though the company has paid $200 and even though now they're owning 50% of the company. And what could happen for Georgia and Irene is that if they subsequently sold Widget Manufacturing Company, they're going to realize a higher capital gain. So that's also a significant tax issue. There are some ways around it if the company is what's called a cash basis S corporation, if provided the buyout is structured properly, or if it's a partnership with special provisions. So this circles back to our theme in the redemption is you need to be very careful with the entity that you're using. There are the benefits, though, in a redemption, and that is really simple. You just have your company owns all the different policies. It controls the payment of the premiums. The proceeds get paid right to it. It handles the sale. And Georgia and Irene, the shareholders, don't need to be involved when Steve passes away with dealing with his personal representative. The company is dealing directly with them. One of the other key benefits in a redemption is we don't have any issues when an owner leaves, because here the policies in a redemption are owned by the company. So if Steve didn't die, but instead he decided to leave, we don't have to worry about Steve walking off on a policy that insures Georgia or Irene's life, because the policies are owned by the company. When we typically use a redemption in shareholders' agreements, we typically actually use a hybrid method. And what that means is that if the company is owning the life insurance, the company must purchase shares equal to value equal to the life insurance proceeds. And then if there are shares that still remain, it then turns into an option to purchase, so that the company has the option to buy the excess shares. And if they don't want to purchase them, then it can go to the shareholders. So it allows the company to decide at death really what's the best option and maybe make part of it a redemption and part of it a cross-purchase. And you really want the option to first be the company and then the shareholders so that you avoid any argument that the company is somehow discharging an obligation of the shareholders. So that summarizes the issues, the benefits, and the hybrid option with a redemption, and the key issue of making sure what type of entity you have, because some of these issues could be more prevalent in certain entities than others. Okay, so now we can go to discussion of the cross-purchase. And so this is where Georgia, Steve, and Irene, in their individual capacity, own life insurance policies on each other. So if Steve passes away, and now he's owning policies on Georgia and Irene, the issues are, first, we have an potential estate tax inclusion issue. Steve owns the policy. Wouldn't the policies be includable in his estate? Those policies have built up value that could be a significant addition to his estate, and I'm sure it wasn't the shareholders' plan that we subject these policies to taxation when the first shareholder dies. The other issue has to do with creditor risks. What if Steve hasn't passed away, but he's going through a divorce, and now he owns this life insurance policy that has some built-up value? Could it be possibly risk in the divorce of someone grabbing the value? Or if he has creditors against him, he's got a judgment order. And so those are significant issues in a cross-purchase agreement that could jeopardize the policies. Next thing is cross-purchases can be complicated, especially when you have a lot of shareholders. In our situation, it's not as complicated, but when you start getting in with numerous shareholders and you have multiple policies going one way and the other way, and it becomes very difficult for the company to keep track of things. One, it's got to make sure everything's getting paid because it's not in control of these policies. The premium statements are going directly to our shareholders. Another issue the company could be facing is to provide the liquidity to these shareholders to pay these policies. How is it going to get money out? Is it going to increase their comp for it? Is it going to turn around and make a taxable distribution? And depending on the ages, and I'm sure nobody's the exact same age and in the exact same health, you could have different premium amounts, which make getting money out of the company harder to pay. The other issue in a cross-purchase has to do with transfer for value. So here Steve dies, and he owns policies on Georgia and Irene. And Georgia goes to his personal representative and Irene together, and they say, we want our policies. Give us our policies that are insuring our lives. And the personal representative says, sure, I'll give them to you, but you need to pay for them. So Georgia and Irene pay for the transfer of those insurance policies. So they've given value to have the policies transferred to them. And then they continue to make premiums until the first of them passes away. Well, with
and Georgia is going to be buying the policies on Irene's life from my estate to help insure against Irene's death, and then Irene is going to be buying the policies on Georgia's life from my estate.
Right, because we're going to be the only two shareholders left. But there's a potential taxation issue there, and that is that under the code, life insurance proceeds could be taxed when they've been transferred for value, and they could face income taxes equal to what they paid for the policy, so what we paid Steve's personal representative for the policies, plus whatever premiums we've made on those policies since we own them. And again, the general rule is you do not want your life insurance proceeds subject to any income tax. You want to have the full amount of the proceeds available for purchase. There are some significant benefits, though, with the cross-purchase, and that is you get a step-up in basis, which if you recall, when we talked about redemption, that's where we didn't get a step-up in basis. So here, because Georgia and Irene are going to be buying the shares from Steve's personal representative, they will be each giving $100. So the purchase price is $200 to Steve's personal representative, and they will be receiving 50%, each of them 50% of Steve's shares. So now their basis in all their shares in widget manufacturing goes from $100 to $200, and they own 50% of the company. That seems a much more fair result from a basis perspective in that they're getting credit for it. The next benefit, and I apologize really, this should read avoids problems with lenders versus avoids creditor risks, is that unlike the redemption where we may have loan covenants that limit what we can use corporate assets to buy shareholders out, here we don't because the purchase is happening directly between the shareholders. So the company's loan agreements are not operative here.
But of course, if one of the shareholders himself or herself gets into like an auto accident or something like that, then their creditors could have a claim on the policy. So like if Georgia got into a car accident and she survived, because I'm not going to kill her off. I'm not nicer to her than she is to me. And she gets into a car accident and she runs somebody over, and then they sue her. They could get her policy on my life, and so it avoids creditor problems regarding the entity, but it doesn't necessarily avoid creditor problems regarding the shareholders. So you're kind of trading off one set of evils for another. But normally we kind of view the company as the one that's kind of out there and exposed more than we think about our individual owners.
Yes, thank you. Thank you for that clarification. Also, too, one thing in a cross-purchase that's happened to me once is that even though my shareholders received the life insurance proceeds on my client, they didn't want to pay him over. And they were required to pay them over, but it took us a while to get them to sit down at the table and follow through with a buy-sell. So that's another situation, is now you've put the money in the hands of the individuals, and they may not be as cooperative as you may want them to be. So our next slide, we talk about the Life Insurance LLC. And this is the vehicle that provides the benefits of the cross-purchase without most of the drawbacks. And so what happens, we form a Life Insurance LLC. So Widget Manufacturing Corp. would form Widget Life Insurance LLC. And the members of the LLC would be Georgia, Steve, and Irene, exactly in the same percentages as they currently own the operating entity. So they'd each own a third. And what would happen is the Life Insurance LLC would now be the purchaser of the policies and the beneficiary. And so they would be responsible for paying the premiums and handling all that. And we don't have to worry now about state tax inclusion issues for our shareholders because they're not owning the policies. We don't have to worry about creditor risks because they're not owning the policy. So if a creditor were to get a judgment against them, only thing they could possibly grab would be a membership interest. And the other benefit is, in the situation that I told you about that I had happened to my client where I wasn't having cooperative shareholders, is that when you do form a Life Insurance LLC, it's preferable to have a manager, somebody who's not involved in the business. And in my situation, had we had a Life Insurance LLC that received the proceeds, I would have had a much more cooperative party because they would have been disinterested and wanted to follow through with the buy-sell agreement terms.
Yeah, just a little bit more elaboration on that. So when you have the company receiving the life insurance proceeds or the shareholders, and they actually have the cash in hand, and then the other people need to try to enforce it, then they can just say, you know, sue me, and they have the cash in hand to defend against a lawsuit, and we know that lawsuits wind up having, you know, nobody really wins a lawsuit, and there's some kind of a settlement value, and I've also had a case where there was a redemption, and the company collected the policy, and our client's estate went to go and cash out their shares, and the company said, sorry, we need to keep that money because we have other needs for it. And so we had a choice between suing them and taking a reduced amount, and it just turned out that the lawsuit would have been a lot more expensive than the purchase price reduction than what we wound up accepting. So when you have the Life Insurance LLC and you have somebody who's the manager, like maybe a corporate trustee or the accountant or somebody like that, and the cash comes into the Life Insurance LLC, their instructions are to just sit on the money until everybody agrees on the buyout.
Right.
So nobody has the upper hand with that. Everybody just needs to get along and to agree, and if the person just sits on the money forever, then that's fine. The Life Insurance LLC lets them do that, and so that does help. The other thing, kind of the way the Life Insurance LLC works is that even though, like, suppose again we have Georgia and Irene, and they would ordinarily have owned a policy on me. So instead, the Life Insurance LLC owns a policy on me, and so Georgia and Irene, as members of the LLC, they are assigned the LLC's beneficial ownership of that policy, and so we can have just one policy on me instead of Georgia and Irene having their own policies.
Multiple policies, right.
Multiple policies.
And it makes the premium cheaper too.
Yes, it does. There are some savings with that, and then if and as Georgia mentioned, if for example, you know, Georgia got sued, they wouldn't be able to get the policy. They could try to get her membership interest in the LLC, but they wouldn't have grounds for dissolving the LLC. They would just have to sit back and wait, and so they wouldn't really be able to get her policy on me. They would just have some kind of a claim against future distributions by the LLC. So then another, go ahead.
Oh, no, that's okay, Steve. You can continue. I think you're hitting all the points.
Yeah. So then the other thing, do you want to talk about the transfer for value benefits, or would you like me to do that?
Oh, you can go ahead and explain that on the transfer for value here.
So as Georgia explained, when we have people coming and going, and again, you know, if I die and then Georgia buys Irene's my policy on Irene from me, then Georgia's going to wind up having to pay income tax on the policy when she collects it on Irene's life. So we're going to kill off Irene before we kill off Georgia. So, but we're making Georgia the sole survivor here. And so as Georgia mentioned, if Georgia is buying the policy in Irene's life from my estate, and when Irene dies, she's going to have to pay income tax on a lot of those proceeds. On the other hand, let's suppose the life insurance on Irene's life or inside the life insurance LLC, and then when Georgia takes over that policy, the policy is just inside the life insurance LLC. So the policy is not getting transferred to anybody. All that's being transferred is my membership interest in the LLC will get transferred to Georgia with respect to the policy in Irene. And so there's no transfer for value rule here. And so there's not going to be any income tax consequence to the life insurance LLC collecting the policy on Irene's life when Irene dies, and then using those benefits for the benefit of Georgia's purchase of Irene's stock. So that helps. Another thing that helps is, let's suppose that we not only had Georgia and Irene and I as partners, but suppose we had another partner came in. Maybe his name might be something like Roman. So Roman comes into our partnership, and how does he get the policy on Georgia and me and on Irene? If he would have to buy the policy from us, then he would have a transfer for value issue. Whereas if he comes in and simply becomes a member of the LLC, then he's buying a membership interest in the LLC, so he's not buying the policy. Similarly, if Irene wound up leaving our arrangement and she were to take the policy on her with her, the LLC could just distribute that out to her, and there would not be a tax consequence to that. Whereas if she had to buy the policy on her life from Georgia and me, and from Roman if he's a member now, then there might be an income tax consequence when we sell that policy to Irene. So the life insurance LLC, it really insulates a lot of different transactions when people are coming and going than it would when you have a cross purchase.
Right, and it's a much easier vehicle to be able to monitor and make sure that everything really goes in accordance with how the shareholders wanted it to do. There are some downsides, though, with the life insurance LLC, and this is really what a lot of times prevents clients from doing them, and that is that it's costlier. It's much more costlier than doing just a simple redemption. There's more counting involved, and there's legal fees involved in doing it. But for those clients that have multiple policy issues and have done life insurance LLCs, they are definitely a go-to vehicle in today's more modern world of buy-sell drafting. So I think, Steve, you're up next to talk about our employer-owned life insurance requirements so we can avoid some income tax on these policies that are owned by Georgia, Steve, and Irene, or owned by Widgetco.
Thank you very much, Georgia. So this is slide 9, and before I get into these rules, let me kind of give some background on the rules. So there was a large company, picture somebody like Walmart or something like that, that had thousands and thousands of employees. And they could predict their employees' deaths like clockwork. It was so regular. And knowing the life insurance is tax-free, they struck a deal with a life insurance company. They bought life insurance on the life of every single worker, not just their executives, but the stock boys even. And then when their different workers would die, they would collect this life insurance like clockwork, and it was like collecting interest, how regular it was, how these payments. But because it was life insurance, it was tax-free. Now, if you think about the stock boy dying and the company makes money off of that, and the stock boy's surviving widow doesn't get a dime, that isn't too cool. That didn't go over very well. So Congress said, if you're going to buy life insurance on your employees, then we're going to have these various requirements, which I'm going to get into with you in a moment, about notice and consent. And if you don't meet these requirements, then the life insurance is going to be subject to income tax. So your normal rule of no income tax goes out the window. You're subject to income tax. Now, these rules apply to any policy that a company bought after August 17th, 2006. So that would be if the policy was issued to the company or if the death benefit increased. That's what these rules apply to. Now, when Congress put the definition of employee there, they weren't satisfied with just saying employee. They decided they had to refer to some employee benefits rules. And when you go and look up those employee benefits rules, they don't just apply to employees, they also apply to a 5% owner. So let's suppose that, again, we have Irene and Georgia and I are all within Widget. And let's suppose instead of Widget being a corporation, let's suppose Widget were a partnership. So the three of us were partners in a partnership. Now, we're not employees of the partnership. In fact, under the tax laws, you can't even count somebody who's a partner as an employee. You have to count them just as a partner. And so we are not employees of the partnership, but because each of us owns a third, so we own 33 1/3%, so we own at least 5%. So each of us counts as an employee, even though we really aren't employees. So now if you get into the buy-sell, so if Widget Manufacturing Company has a policy on us, then Widget has to get the notice and consent from us, even though we are not technically employees. We're not technically employees, but for purposes of this rule, we are considered to be employees. So let's go to the next slide, 10. Now, this notice and consent, and I'll give you samples so you'll see what they look like in a moment, but the notice and consent must be obtained on or before the time the policy is issued.
And there have been so many times, Steve, that I've had clients that have come in and they've had these policies and there's been no notice and consent.
And I agree with that. And I will also go in and check and ask, what is the notice and consent? Show it to me. I want to see that what you did qualifies. So I had a case a few years ago, and I went and said, I asked the insurance agent, did you get a notice and consent? And they said, of course we did. I said, well, please send it to me. So they sent me something, and what that something said was, we hereby inform you that there are tax issues involved with this. Please consult with your tax advisor. And that's what they purported to be the notice and consent. And that did not qualify, because you'll see when we get to the samples in a moment that it looked nothing at all like what you're supposed to be saying.
I have found, Steve, though, that insurance agents that are typically in the business of selling buy-sell insurance, some of them have that actually incorporated right into their application, too. Have you seen that?
I haven't seen that.
Yeah,
but,
I recently had it on one client. They had it right in the application.
But I'll tell you what I have done before is I did cobble something together. Where I had this client. They came to me, and it was very sad. One of the big owners of the company, who was also the president of the company, he had terminal cancer, and I went and asked for the notice and consent, and they couldn't come up with a separate form. So I asked for all the documentation relating to the issuance of the policy, and it turned out that the insured had signed every single thing dealing with that company. And fortunately, even though he was terminally ill, he still had his wits about him. So what we did is I cobbled together an affidavit where he said, here's this paper I signed, there's that paper I signed. When I signed these papers, I understood all of these different elements that I'm going to be going through with you in a moment. And so we had him sign that affidavit, and we put that together along with all the evidence, and then we attached to the income tax return for the company a form 8975 that said that we have IRS, there's an uncertain issue here, and we don't know the answer to the issue, and we're going to flag it to you. We think we may have a case, but we don't know, but we're going to flag it to you. And I told the clients, I said, this $8 million of proceeds you get, you need to reserve income tax on that. So I said, set aside $3.5 million of that money that you were otherwise going to be using maybe for some business operations or some key expansion. Set that aside for possibly paying income taxes within the next 3 years. So they did set that aside. But that's not a good result for them to have to set that aside and to wonder about whether the IRS is going to come in and try to grab a few $1 million from them. So that I've done. I've done that before. There is a procedure if you have that notice. Actually, you know what? I'm going to tell you a little about that later. That's in one of my later slides. Let's talk about the notice for a moment. It can be drafted by the attorneys or the CPAs, or it can be provided by the agents. And a lot of the insurance companies do have really good forms. But again, you just want to make sure that the form that you're provided is actually something that qualifies and not some other notice. Not just something because the insurance agent may or may not really understand what's required. They just know there's a form that the company tells them to give out. Also be aware that there is an IRS form that needs to be attached to the corporate income tax return every year, Form 8925. So let's go on to slide 11. Right? Yes.
Yeah, that's every year they have to attach that. It's not just the initial year of.
Right. Every year they have to attach it.
That's another area where I've seen kind of a dropping the ball.
Yes. Fortunately, the penalty for that is just some penalties, but there's no huge income tax burden because of it. But you still want to do it. So, slide 11. Here's an employee. This is a sample form, and again, don't just use this form on your own. You know, just like all the commercials, don't do this at home, okay? I just want to give you an idea of what to look for and make sure you go to a qualified tax advisor who can tell you what actually works. So this is a notice of consent. Again, if Georgia and Irene and I are partners in a partnership, and so we're not employees, well, what do? So here's a notice of consent. And where you acknowledge notification that the employer intends to obtain a policy, I'm insuring my life, with a maximum face amount of blank. Now, this notice is only good for whatever face amount you put in there. Now, that doesn't mean that that has to be the face amount right now. Suppose you have a life insurance policy that has $1 million face value right now, but maybe there's some options in there where it might go up to $2 or $3 million. So just fill in that $3 million figure in that blank. Just because it's not $3 million yet, it still could eventually go up to the $3 million. And the goal is to put the employee on notice, or in this case, the partner on notice, that the amount might be as high as that. So when in doubt, put in a higher number and just anything. So because if you put in a lower number and then the face amount increases over that lower number, you got to get the consent again before it increases. So then we have what else do we have in there? We say, although the employer does not employ me, I understand that I'm considered to be an employee for purposes of the tax law. So they understand why they're getting this notice and why they're called employer. So therefore, I acknowledge that the employer intends to ensure my death, my life regarding the death benefits. So I consent to being insured, and that even after I'm no longer having the status of being an employee, the company will continue to have the policy, and that the employer will be a beneficiary. So this is just putting them on notice. Now, I have had times where an executive agrees with the company that they will get some of the benefit, that their family will get the benefit. So we have them sign the notice because we want to have something to stick in front of the IRS and show, yes, we complied. And then in the employment agreement, we would simply say, notwithstanding the notice, we agree that the company will provide this benefit. So this is not legally binding on anybody. It's just a notice that you get that the employee needs to know that that the company, they need to negotiate with the company on what the benefits might be. Then you can do your separate standalone on what those benefits actually are. Now let's go to slide 12. Employer-owned life insurance consent for an employee, and this is the same type of thing as a prior form, only this is for somebody who really is an employee. And so this again is what somebody like Walmart would give out to its greeters if they would have some kind of thing in place like that. Okay, so let's go to slide 13.
Steve, these notices, a lot of times we weave them into our agreements, our shareholder agreements or our operating agreements.
Exactly. So thank you for setting me up for my third bullet point on slide 13.
Perfect.
So on slide 13, you know, we have the best option of course. What are your different choices? One of those is, as Georgia mentioned, the buy-sell agreement can protect the arrangement if the agreement includes a notice and consent. And I do have some standalone supplemental materials, which I'll talk about a little bit later, that actually do have something like that built into the buy-sell agreement. Now, the best practice is a buy-sell agreement refers to maybe a formula or a schedule or something like that. But the best practice is to get a separate notice and consent. Because again, if the IRS comes knocking on your door, what would be easier? Giving them a buy-sell agreement and explaining to them how it works and where your provision is, or giving them a one-page notice. So the answer is we just want to give them the one-page notice so they can check off on the box of their audit things and be on their way. So now at the top of the slide, so what are the other options? Get new policies. So in that one where I told you that the insurance agent sent me a form that just said there's some tax issues involved, and that clearly didn't qualify, the policy was just issued like a couple months before that, and it was term, and so we just got the life insurance company to reissue the policy, and we made sure the notice was signed.
Yeah, I've done the same thing too with a few clients that have come in here with policies that aren't that old. It's a lot cheaper from a professional fee standpoint, and trying to figure out how to clean it up to just go out and get the new policies, provided their health hasn't changed.
Right, and who wants to have the risk? You just have the very clean piece of paper you can stick in front of the IRS's face. But as Georgia mentioned, you know, it's not always possible to get a new policy, because suppose this policy were issued in, say, 2007, and now here we are 9 years later, and we discover that that consent was not issued, and all of a sudden that person has had a health problem. So then we're not going to be able to get a new policy for that person, or it just might be unaffordable, and so that would not work. So the other relief that's available, well, this is not a 9-year situation, but you have the procedure in place and actually make a mistake. So everybody who is considering buying this life insurance, what you might want to consider is to have a formal written policy that says whenever anybody comes on board, we're going to notify them that there's a policy on their life. And then if you have a foot fault and maybe the HR person was out that day and they didn't get that form put in front of them because the substitute didn't know where to look for that form, and then you discover it and you fix it like right away. So like, you know, you discover that and a couple months later go and fix it, you know, that can be okay. But you have to have the policy in place, the procedure in place. And so what we often find is people did not have a formal procedure in place, so this relief for fixing in a short amount of time is not available. So so most of the time that does not apply. And then of course, as we mentioned, the buy-sell agreement, and there was actually a private letter ruling where somebody says, hey, we caught the mistake, can we get a relief from this mistake because we fixed it in a short amount of time? IRS, do you agree with us that we fixed it soon enough? And the IRS said, well, you know what, we're not even going to go there. Your buy-sell agreement referred to it sufficiently, and so you don't have to worry about getting relief. You already complied because of your buy-sell agreement.
So, Steve, now you've explained to us about the insurance and that we have to have our notice, and we've got it all wrapped up, and now we're getting ready to figure out our purchase price. And we have to determine, it's very important that your agreements determine or set forth how the insurance affects the purchase price. And that's important for both financial and tax issues. And first, you know, a lot of agreements, and we've had a lot of clients that come in and ask for this, will provide that the purchase price will be the greater of the value of the deceased shareholder shares or the proceeds received by the company. So what this has the effect to do is if your shares are valued less than your insurance proceeds, you're now bumping up the purchase price. And from an estate tax perspective for our deceased shareholder, you just increase the value of the shares that are going into his, or valued on his estate tax return if he's required to file one, and which could result in more estate taxes for this deceased shareholder's estate. The other issue is that, you know, when you're bumping up the purchase price for the insurance proceeds, sometimes the company may actually need that money, and it's an additional kind of way to get the money to the company without them having to go out and buy a separate policy on a key man. So great care should be taken in bumping up purchase prices to life insurance proceeds. Although it's common and a lot of clients request it, it really should be thought out because it's not only affecting some company issues, but it could be affecting the deceased shareholder's personal tax matters. The next thing you have to worry about is if you have a formula in your agreement, how is the insurance going to be factored into this formula? You should be clear about it, that it's not going to be in there. If it's going to be in there, most of the times it's not. But you should definitely say that in the agreement. The next thing that's important is the valuation date, the date that you're going to pick to value the company. And it's preferably to be the date, not the date of death, but maybe the month preceding the date of death, so that you're not calculating in the company's receipt of those insurance proceeds. So these are really important things to think about with insurance, you know, when you get to the final steps of your buy-sell and determining the purchase price to keep in mind.
Thank you, Georgia. So now we'll go on to slide 15. Recent developments for family businesses. There was a recent case where a 94-year-old woman advanced funds to trust for her children to facilitate their buy-sell, and it was structured in a way where even though she advanced the money, she wasn't going to get it back for many, many years, and what her estate included as a value, a much discounted amount, because she wasn't going to get the money back for many, many years. So in this particular case called Morissette, there was basically this advance of this money, and it was not considered to be a gift because she was eventually going to get paid back the money, but for estate tax purposes, they valued it at a big reduction. And so that case is still going on. This is a controversial area, but it is an area where if you have any family members and the second generation owns the business, consider whether the first generation might help finance those premiums. The other thing is that there are some proposed regulations that have been issued where the IRS wants to artificially increase the value of people's businesses. And these regulations themselves are highly controversial. Their effect is unknown. Some people say it will increase the value only a little. Some people say it will increase the value a lot. And so it's really wise for people to right now try to do things to do these transfers. And there will be a webinar that's on slide 19 that we'll show you later that will be discussing this. But just consider under your buy-sell agreements, is this going to increase the estate tax value? Is it going to want you need to set aside more life insurance to pay estate tax? Does your buy-sell agreement refer to a formula that refers to the estate tax value? Because if it refers to the estate tax value, and now the estate tax value is all of a sudden artificially higher, maybe you need some more life insurance to take care of that. Now let's go on to slide 16. Also beware with these life insurance arrangements. You know, we normally clients set it up for term life. You know, the problem is that when a person gets older, the premiums go way up. They skyrocket. It becomes unsustainable. So what are you going to do then? So you know, certainly there are people living longer and longer and longer. So it's not unheard of for people to live into their 80s, 90s, 100s. You're not going to have a term policy on them when they're 95. That's just going to be ridiculous. So consider buying permanent life insurance to be able to have this policy permanently be around. And if that's too expensive, you know, consider at least setting aside some money somewhere to be able to fund this, so that when you have to reduce and then eventually eliminate your life insurance, you'll have something around there. If you do have term policy, see how far out you can have their age go so that you can have them insured and locked in at that rate. That does two things. First of all, you kind of know what you're getting into because you know what the rate is. Second of all, if you're going to renew it and they've gotten sick in the meantime, boom, all of a sudden your premium skyrockets, not because they got older, but because they got sick. So try to make things as certain as possible. And I already mentioned about getting the liquid assets. So I'm going to go to slide 17 and mention that we have some supplemental materials. And when you get your evaluation form, there will be you'll be able to download the supplemental materials. There's really three different supplemental materials. One is excerpts from some materials that I had that go into all these technical issues. And the excerpts also include a more thorough discussion of a private letter ruling that I got from the IRS on how to do a life insurance LLC. So I created a life insurance LLC for my clients, and we submitted it to the IRS with their permission, and the IRS blessed it. There's also from the American College of Trust and Estate Council, ACTEC is basically the top estate planning lawyers in the country. You have to be practicing trust and estate law for at least 10 years, be recommended by somebody outside your firm, and made significant contributions to your profession. And a task force that I was on for ACTEC, we put together an outline that talks about shareholder agreements. It's quite lengthy. We also put together some form provisions. It's really not a standalone form that you can use on your own, but it just has some clauses in there. You might want to consider comparing those to your buy-sells and just seeing if there's anything useful in there. Slide 18, those materials that I have excerpted are actually part of 1,100 pages of business structuring materials. Those of you who are technically oriented, you're welcome to email me and to get a copy of this 1,100 pages of business structuring materials, and then happy to send you that PDF, and you can get the most recent version on it through a quarterly newsletter. Slide 19, we're going to have another TCLE webinar. Again, this is a free webinar that's for CLE, and we're going to talk about business planning in light of the proposed regulations on that Code Section 2704 that would artificially increase the value of businesses. And you can see there's a link to the registration. So, Georgia, I think there was something we might want to talk about while we're waiting
yes,
for some questions.
I had a question for you that we've discussed before in the past, and that is, so if you've passed away and your personal representative is holding the life insurance on my life and Irene's life, and we want to buy it, how do we do that? How do we determine what to pay for it, and how do we buy it?
So the question would be, how do you buy the policy from my estate? So basically, the first question is whether you have a right to buy it to begin with, or whether this is some kind of a voluntary thing that we do. And then the other second thing really is who's going to want to buy it. But once you do it, we would typically, what we do is that the life insurance, you go and get a valuation, and the life insurance company will provide for you upon request. They will provide an IRS form that determines the value. That's IRS Form 712. And so that's basically the presumptive value according to the IRS on what the policy is worth, and then my estate would seek to sell it to you for that Form 712 value. Now, that Form 712 value might or might not be the same as a cash value. In fact, if you have a term policy, there might not be any cash value, and it might just be, what the unexpired premiums is. But a lot of times, policies have riders in them, extra features that are not reflected in any cash value. And those riders might have significant benefit. And so the Form 712 might come back with something else. And then the other issue is
which could be a higher value, right?
Yes, it could be a higher value.
Policies where it's been a lot higher than the unexpired premium.
That's right. And another issue might be that's just a presumptive value. If for example, and since George is surviving everybody, I'm sorry to Irene. She's helping us behind the scenes with this webinar, and but she's pretty healthy though. I trust me. But if Irene got sick, and then that policy might have a higher value than what the Form 712 will come back with, and so there might be an actual economic value which is higher. Now it could be that never comes up, but people should just know that these policies can unexpectedly get higher values.
And then now they have to come up with more money to buy them from the deceased shareholder's estate, which is kind of another reason the Life Insurance LLC, too, has also become more and more popular because of this kind of unknown that you really don't want any unknowns. You want to figure out everything.
And the operating agreement for the Life Insurance LLC would specify that stuff.
Right.
So we did get a question here. Should it be an attorney's standard practice to include notice and consent language in every LLC operating agreement with at least some minimum level of dollar coverage specified? So the answer is that yes, every LLC operating agreement, every corporate shareholder agreement should consider this issue, and ideally, you would mention a minimum level of dollar coverage, because what the statute says is that we have to say what the maximum face amount is. Now, if you don't know the face amount, then I would do a formula, something that can be readily ascertained. And at least you can argue to the IRS, well, it would be that amount. But what I would also do is maybe you have that formula in there, but you can also say, here are some policies that we're going to buy for this. And those policies, you might overinsure the person. I mean, if you're going to be buying them out for $1 million, maybe you still buy a $2 million policy in their life, because the value of their interest in the company might go up to $2 million. And when it goes up to $2 million, they might not be able to get an affordable life insurance policy on them, because they might get sick by then. So you're going to want to. Yeah, go ahead, Georgia.
Where you need to be careful too with what you have in your buy-sell agreement about popping up the purchase price to the value of the life insurance proceeds, because the company might need that extra. If they overinsure, they may be overinsuring to also provide some liquidity to them.
That's right. There's a so-called key man policies where you need the money when the person dies to help transition to the next. So we definitely want to be aware of that. So yes, your buy-sell agreement should address this. You should put dollar amounts in if it's at all possible. You should consider overinsuring. You can refer to specific policies or specific dollar amounts. And what the heck, I mean, even if you don't have that $2 million policy I recommended, you could still put in that here's the formula. We anticipate that it's going to require, it could require as much as $2 million of life insurance in the future. So that would be a fine thing to put in as well. Well, we have, it is now the witching hour. Our hour is up. I encourage people to, please, first of all, we thank you for attending, and you're certainly welcome to download the materials. And if you have questions, you'll notice on the very first page of our slides that we have the phone numbers and emails for both Georgia and me. You're welcome to contact any of us or any other person you know at Thompson Coburn and to ask questions, and we're happy to follow through with you.
Thank you, everyone.